This week, commotion surrounding Deutsche Bank has wiped yet more value from the share prices of European banks. Some may now be tempted to view these battered equities as cheap. They should not. The perennial cry of the brave and the foolhardy for several years has been that European lenders are cheap because they trade at very small multiples of the accounting value of their assets. Using this logic, investors have poured magnificent sums into recapitalizing the continent's banks since 2009. They've subscribed to more than 200 billion euros in fresh equity. At the same time, the total market capitalization of the Euro Stoxx 50 bank index today sits at around 350 billion euros, meaning that much of that fresh capital has effectively been set on fire. The sheer quantity of money that has already been stumped up by optimistic investors pales in comparison with the cash that is going to be needed to plug the remaining problem. There were, according to PwC, 1.9 trillion euros of non-core bank assets that were still held in Europe's banks last year, and 850 billion of these assets are non-performing. And compounding this problem is that banks are going to be unable to generate the profits that they need to grow their way out of this situation, and many are nowhere near able to generate more than their cost of capital. So as such, the cheap multiples of book value that many European banks are trading at is merely reflecting the near certainty that there will be many more rounds of dilutive equity issuance to come. Shareholders are going to be the losers. The winners are going to be distressed debt investors who are able to snap up the glut of loans and other non-core assets in what is very clearly a buyer's market. There is money to be made with European banks today, but anyone trying to do this by buying up their shares has been looking in the wrong place.